all these banks paying back the TARP, Wells Fargo being the latest. Wells was a name that you had been short in the past, so you're very familiar with the balance sheet here. Wall Street commentary today, very positive on the news. What's your take of this?
Well, almost all the banks that have raised significant equity capital have seen their stocks go up initially on a relief rally. I think the jury's out on Wells still, though. I mean, they've got a fair amount of reasonably difficult loan problems ahead of them. Now, whether they've got enough capital to make it through that, I think the market today thinks obviously it's plus, but there's some other shoes to drop is my guess in that stock.
When we hear about the news of Bank of America, Wells Fargo, all of these banks paying back the TARP, there is an assumption being made amongst some investors that that means that their balance sheets are healthier than they had been a year ago, 18 months ago, et cetera. You had been short financials. You covered that position mid-2008 or so. Would you say that the balance sheets are substantially better today than they were before?
Well, they're certainly better than they were 6 to 9 months ago. Whether they are still in as good a shape as they should be is the $64,000 question.
Right.
And again, I think we've kicked the can down the road with a lot of loan problems, not only just in commercial real estate, but even in second mortgages and a lot of other things, as well as some securities that have been marked up dramatically since the accounting changes in April. So I think the jury's still out. I wouldn't be a buyer here. I don't know that would be a seller, but again, I'm pretty ambivalent about the sector.
So right now, it's not strong enough of a conviction of yours to actually short any of these names. This is a sector that you're simply staying away from.
By and large, we're staying away, with a few minor exceptions.
Okay, let's talk about the markets overall. We've seen a sort of melt up in the markets of late. We're just off of 14-month highs. What is your take? Because some other legendary hedge fund managers who might go by the name of Jim Paulson say that their net long positions are the highest they've ever been. What's your portfolio look like? How do you assess your opportunities in the market as a short seller?
Well, we're always net short. I mean, and our clients give us money to be net short, and we earn our fees on how we do relative to the market. So, so basically, we're long the market and short our stocks, in effect. And I think that right now there's all kinds of opportunities, as there always is, but it's in shorting individual companies and maybe sub-industries, not necessarily being short the market.
And is that a difference? How is that a difference from?
It's not a difference. I mean, that's always the way we've run away.
Not sector, but stock specific.
Exactly.
Let's talk about some of the specifics then out there. Autos, that is an area that you are short currently. We were short.
We covered through the course of 08 and early 09, and we're back in, both here and in Europe. One of the interesting things about the auto sector, it's a sector that has chronically lost money, like airlines, but capacity doesn't leave. Even with the bankruptcies of GM and Chrysler, we've seen increased worldwide capacity in the last 12 months. And industry bulls are hoping for a level of sales to go to a level that heretofore would have been considered depression levels. So I think that this is an industry that has really, really still got to grapple with the problems of overcapacity and, in many cases, still legacy costs.
Manufacturers, auto parts makers, how are you short?
Right now, the OEMs, the manufacturers, is the best place, both in Europe and here.
And here, any specific names that you can give us?
Well, I wouldn't be long Fiat or Ford, put it that way, the F brothers.
Okay, let's talk about a sort of a related sector. You had mentioned the airlines. That's a sector that has certainly been doing quite well of late. Do you see that as also having chronic problems? We're in a time in the economy when the state of the consumer is a little bit rocky.
Yep.
Is this an opportunity?
Well, I mean, I think the IATA came out today with some new 2010 forecasts, and they expect the industry to lose another $5 billion.
Right.
I mean, this is ongoing in this industry. I mean, it never seems to have prosperity anymore, even when the economy recovers. But we're focused actually right now on one of the two airframe manufacturers in Europe, EADS, which is the parent of Airbus. And we think that their problems are myriad, and they'll ultimately need state support. And we just don't think the shareholders are going to benefit from that. Okay.
Also want to talk about China. There is a conventional wisdom out there that China is the power of our global economy, and that may be the case for now. But according to some reports, there was a research report that was very popular on your trading floor, and in that report it said, we believe the coming slowdown in China has the potential to be a similar watershed event for world markets as the reversal of U.S. subprime and the housing boom. Is that in line with your thinking? Because that is a very drastic conclusion.
Well, I thought you were going to talk about when we said that China was Dubai times 1,000 or worse. I mean,
so I guess it's not drastic.
It's not too drastic. No, The irony about China, Melissa, is that Western investors who decry the amount of government involvement, say in healthcare in the U.S. or government intervention in the financial markets, and really find it distasteful, are quick to grasp the fact that 25 members of the Chinese Politburo in Beijing are able to fine-tune this rapidly growing economy. And we also just don't believe the GDP numbers. We think they're massively inflated by underdepreciating a very, very, very shaky capital asset base.
So when is it going to rear its ugly head? When are investors finally going to realize that all this economic data, as you say, is not believable and not grounded in reality?
Well, I see that last night they talked about, the authorities there talked about, increasing the loan volume by another $1.2 trillion, 8 trillion won. As long as they keep the credit going, I think the game will continue. As we know, that bubbles are best identified by credit excesses,
right,
not valuation excesses. And there's no bigger credit excess right now than in China.
Isn't there a problem, though? I mean, first of all, you can't short the Chinese market. You can't short the individual stocks. That mechanism simply doesn't exist in that market. But also, in terms of credit, the government, as you mentioned, because it's state-run, can keep that credit flowing. They can keep pumping it in. So you're not operating in fundamentals, even though you believe the fundamental case for this economy is not solid.
Yeah, and I don't think I'm traveling to Shanghai anytime soon either, Beijing. I'm sure they're not happy with short sellers. But then again, they aren't happy with short sellers anywhere,
right,
so I guess that doesn't really matter. I think that, no, the A shares are not shortable.
Right.
So one has to, if one is interested in doing China, one has to look at the H shares in Hong Kong, excuse me, or has to look at the first derivatives, which would be the commodity plays, people shipping, raw materials into China for the buildup of their infrastructure.
So
and I think that's
gold
what
miners, the copper producers.
Copper, cement, iron ore, those sorts of things.
Do you think the greatest opportunities are some of the Australian ones, the U.S. ones? Where are you identifying those derivative plays? Yes, 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 across the board?
I think there's opportunities in all those areas.
When you take a look at the price of the precious metal, when you take a look at the price of the commodities, and a lot of that is based on the weaker dollar, do you also think that that is in a bubble then?
Well, gold we'll put aside because gold, no one's constructing anything out of gold as far as I know. But in terms of the aggregates and everything else, China's clearly the story. And we're seeing the tail end of construction booms in the Middle East and in the West, but China's going full bore. And that's where everything is heading. And that's, if I was long these things, that's what I would be watching. I wouldn't be watching the dollar.
Are these shorts that you're putting on right now?
Yes.
They are. So as we speak, you're shorting a lot of these commodity producers.
We are actively looking for plays on the China investment boom, which we think will burst at some point.
Doesn't it hurt, though, Jim, when you see the prices of commodities continue to rise, defying gravity and defying expectations, and you can continue to see the dollar turning weak? Those things are going against your shorts at this time. At what point do you think this will work out for you in terms of a trade?
Nothing we're not used to. I mean, we're often early in these situations, Melissa. You never get the top tick and you never get the bottom tick. And anyone who says they do is probably doing the Chinese GDP reports.
Last question to you, Jim. Got to talk about the weaker dollar. A lot of people say it's the most crowded trade on the street in terms of short sellers shorting the dollar. Is that your opinion? Are you short the dollar?
We don't play currencies. It's anybody's guess. We have no idea.
Are you concerned about how that interacts with the price of the commodity and therefore the commodity producers? Because you are exposed to it in some fashion because you're short the commodity producers.
Sure. Well, I mean, in effect, we are. And we obviously have to be mindful of that in our risk exposures. But it's not anything we can fundamentally analyze. So we try to stick to those things we can fundamentally analyze. And demand in China is overinflated. That is clear.
Right. Okay. Jim,